There's no shortage of big trends, risks, and opportunities to talk about in 2026. But it's not often you get to learn about them from one of the sharpest, most forward thinking experts in America. You'll have the chance today on the Money Show Money Masters podcast and at our upcoming 2026 Money Show Las Vegas. My guest and next month's keynote stage headliner is Jason Schenker. President of Prestige Economics and chairman of the Futurist Institute, he's known for his accurate, independent economic research. He has also written or edited dozens of books, including geopolitical treatises like Cold War II and his latest #1 bestseller, The Future After AI. In this episode, you'll learn what big picture trends you need to pay the closest attention to as an investor, how key geopolitical and economic developments could impact markets in 2026, and where AI technology is headed next. Well, Jason, thank you so much for taking time out to chat with me here today. Obviously, a lot going on in the geopolitical front, the AI industry, the economic questions out there, a lot of things investors are dealing with here in early 2026. So before I get to that, since you're on the podcast for the first time here, I was wondering if you can tell our viewers and listeners a little bit about your background and what your specialty is here.
Yeah, I'm Jason Schenker. I'm the president of Prestige Economics, chairman of the Futurist Institute. I have written dozens of books and I advise various kinds of leaders across organizations on various kinds of economic, financial market, and risk management topics, in addition to geopolitics and AI.
Got it. Well, there is definitely a lot to unpack out there, but I want to maybe start on the economic front. Here we are, with some questions about the strength of the labor market. I guess I would probably describe the latest numbers as a little bit squishy, but not recessionary. What are you seeing when it comes to labor, when it comes to kind of consumer business spending in this first quarter here of 26?
The economic data around the labor market is kind of a mixed bag. On the one hand, we have an unemployment rate that's gone up quite a bit, but it still remains relatively low. We also have seen payrolls be extremely weak, the weakest payrolls in years. And of course, we've seen in the last 6 months, we've seen a handful of contractions in monthly payrolls following some revisions. So that's not great, but we also see that there's almost 7.2 million open jobs and less than 2 million people collecting unemployment, which means even though payrolls have slowed, there's still a lot of open jobs. And so we're seeing a bifurcation in the labor market where there's lots of open jobs in physically demanding in-person roles. Think about healthcare, manufacturing, transportation, warehousing, utilities. But where there aren't open jobs is for recent college graduates. Those entry-level professional services roles, a lot of that's dried up. And if you look at the unemployment rate for recent college grads, that's gone up a lot in the last year. Those are very high rates relatively now. So that's where we see that split, and that's where you're, I think, hearing a lot about that. But the number of open healthcare jobs is more or less infinite at this point. The question is, are those recent college grads going to go into the healthcare space? Are they going to go into manufacturing? Are they going to go into transportation, warehousing, utilities? So there's a bit of a mismatch in the economy, but the risk going forward is, does a few months of contractions, modest contractions relatively of payrolls, turn into a bigger set of drawdowns in payrolls? That seems something that, one, the Fed is very concerned about, but two, I'd say is a little bit less likely than in past cycles because we've got well over 7 million open jobs right now. Of course, the unemployment rate could keep going higher, and I do expect it will rise further because what's happening is even though payrolls have continued to rise, the number of people looking for jobs is going up faster. And so unemployed folks, that in what's called the household survey, you see more people looking for work than are getting work, and where they're looking for work isn't where the jobs are. And so the unemployment rate could keep going up, even though payrolls remain kind of flat or even up a little bit. And even though there's a lot of open jobs and very few people are collecting unemployment. Because, of course, if you're a new market entrant, like a recent college grad, you're not going to be collecting unemployment because you never had a job to collect
Yep.
unemployment from in the first place. So you've got a few things moving on. Labor market's a really big question. Inflation's the other big question for the Fed. And yeah, we're at a moment that is precarious.
I'm glad you brought that up. I mean, obviously, the implications for the Fed here are significant. I think after the latest numbers came out, you reiterated your base case for maybe two 25 basis point cuts as the year goes on. Is that pretty accurate? And what might change your thesis one way or the other?
It would have a lot to do with the two things the Fed watches: the unemployment rate and the labor market and inflation. And while we know the labor market has softened and we've seen a deceleration, the question is, does it flip and then move sharply lower? And if it doesn't and it just remains weak, that the Fed, could cut rates occasionally to kind of keep things moving along. But the Fed really can't cut a lot because the dual mandate, right? The Fed does two things. They have to support full employment, maintain low, stable prices. And right now, inflation rates between 2.5% and 3% are still above the Fed's 2% target. They're a lot lower than the 9% rate we saw back in 2022, but certainly 2.5 to 3, a lot better than 9. But if the target is 2, and the Fed has continued to reiterate that that's its target, 2.5 to 3 is still a little hot. And that's where the Fed's got to be careful. If inflation were at or below 2, I think they'd be cutting rates more, but they have to balance that. So what would change my view? If inflation remains stickier, in other words, if it accelerates further from where we are now, that could be a really risky scenario for the Fed. And they may decide, you know what, we're looking at inflation closer to 3, above 3, and that's for well into this year. Then that could impact this year. Maybe they won't do two cuts.
Yeah.
Or if inflation begins to year on year decelerate, gets closer down to 2, well, you know what? Maybe they're going to do 2, or maybe they're going to do 3, or maybe even more if we see the inflation rate fall. But the biggest catch right now for inflation is that in recent months, what's supporting inflation isn't tariffs, it's
Hmm.
the labor market costs and service sector inflation in things like healthcare and shelter costs. Those things are what's supporting inflation, which means as we think about how does the Fed solve this, well, if labor market tightness is causing the inflation that's preventing the Fed from cutting rates, now you have this circular feedback loop that really does limit how many cuts they can make. So if they cut too much, right, and then you're going to get a lot more job activity, well, then you might get a lot more inflation, because the inflation right now that we've seen over the past year is predominantly because the service sector it has a lot of inflationary pressures.
Got it. I have to pivot to the next big topic on, I think, a lot of investors' minds, and that's geopolitics. You authored the book Cold War II. You talked about how the geopolitical backdrop has really changed a lot in recent years. So I was wondering, can you contextualize that a little bit here, given what we just saw happen in Venezuela, given some of what's happening in Eastern Europe, and now, of course, what potentially could happen, with the China-Taiwan situation simmering in the background?
Yeah, and of course there's Iran as well, where you see all these protests and potential changes there as well. So Cold War II is a framework I've been talking about for a number of years, based on some work I did for the Pentagon back in 2020, and then some additional follow-on work I've done subsequent to that for National Intelligence University, some reports that I'd written, including a peer-reviewed section of a book about the world emerging from pandemic. That was in 2021. There have been growing concerns and risks around US supply chains, especially for dual use technologies, and these growing antagonisms between China and its allies, including Russia, Iran, North Korea, and the United States and its allies. And I was talking extensively about this back in 2021, which is how in 2022 I secured a trademark around the term Cold War II in multiple classes in the United States for work I'd been doing in 2021 and for a series of talks and consulting projects that I'd rolled out around this topic. And of course, then the Russian war on Ukraine started in February 2022. So after I was already talking about these kinds of risks and the real geopolitical tensions that we could see resume and return and revisit from the 20th century. And that's what we're really seeing here, right? It's a maybe less of a very clear-cut ideological game of communist and capitalism, but it's very similar, right? Cold War One and Cold War Two look now very much like they're two parts of the same conflict with a 50-year armistice to determine the Asia question and China's propensity for economic, political, and military hegemony over Asia. That really begins to look like actually maybe that's what Cold War One was about, right? We think about where did Cold War One go hot? Of course, born in the 70s, raised in the 80s, Russia was the main focus, but that's because a certain level of détente had been reached with China in 1972 when Nixon had his China moment and flew over to Beijing, shaking hands with Zhou Enlai on the tarmac, the Chinese premier at the time. All of that happened in 1972. 50 years later, in 2022, almost 50 years to the month of the handshake on the tarmac, Russia invades Ukraine. And of course, 50 years to the month of that handshake, you see Russia and China announce the Beijing Olympics, no limits to their cooperation, and that they uphold the outcomes of the Second World War, right? To say that you support the outcomes of World War II in 1946 or 47 or 1950 seems reasonable. Kind of strange to say it in 2022. You support the outcomes of World War II. Well, that's a okay, all right. That's kind of a strange thing. And of course, then it's not a coincidence that a few weeks later, Russia's invading Ukraine, right? Because if you uphold the outcomes of World War II and you're Russia or China, the implication is Russia bigger, China bigger. And so
Yeah.
now you see these tensions, these conflicts are all part of the same thing, right? Russia and Ukraine, Iran and its proxies in the Middle East, which had always been a major battleground in Cold War One. Now we see Venezuela and Latin America, another major battleground in Cold War One, and China and Taiwan, another really big risk. So, where does this go from here? There are growing risks that if China were to become more militarily aggressive with Taiwan, and if there were to be an active kinetic conflict, that there are some really big, painful things that could come of that economically on a global basis. And I'll talk more about that next month when we see each other at the Money Show in Vegas. But there are some real risks at play, but there, of course, are also some opportunities.
Yeah, absolutely. Jason, the other area that you focused on a lot lately in your work has been artificial intelligence. You wrote the bestseller, The Future After AI. Talk a little bit about the questions you're hearing. What drove you to write this book, the questions you're hearing from clients. And I know you mentioned it's sort of the new operating system for finance, technology, energy, and so on. What does that mean?
Yeah, so I've been covering these materials for a long time. So in Prestige Economics, I founded in 2009. And the goal of that was to provide financial market research and consulting services to corporations and financial institutions in a way that bridged a gap, right? Because coming out of both investment banking and then out of consulting, I saw in banking that oftentimes folks on the finance side didn't fully understand how corporates worked. And then after having been on the consulting side, I saw that folks in the consulting and corporate side weren't always watching markets. So that was in 2009. In 2016, I had clients coming to me increasingly asking me about long-term technology risk. So this is now 10 years ago. And I developed and launched an entire series of books and courses and training programs, a certification that's been taken by countless industries. Hundreds of thousands of people have taken the courses produced by the Futurist Institute, which, again, founded in 2016. And the first book I wrote on the technology topics was Jobs for Robots and looked at automation and AI and all these things that were coming again 10 years ago. And then subsequent to that, oversaw the production of these compilations of works called the Robot and Automation Almanac, or a number of other futurist books. And so this concept of AI is something obviously I've been writing about, talking about for a decade, and quite extensively in my talks and in my books. The future after AI really explores what comes now once AI becomes more or less invisible, right? Maybe you might recall, right, in the 90s, early 2000s, if somebody said, "Hey, I've got a company website now," and maybe be at dinner and people would be impressed. Wow, you're on the internet? Wow, I mean, I remember I think 1995, I went to college. It's the first year we were required to have computers. Prior to that, people used typewriters, and that was a big deal. When I graduated high school, I was one of the few people I knew with an email address. And so, at some point, people were like, "Oh my gosh, you have website, you have an email address." Today, if you tell someone you have a business and you're like, "I have a website, I have an email address," they will, of course you do, right? Next thing you're going to tell me is you have an office with indoor plumbing and electricity, right?
Yeah.
Looking forward, people right now, everybody's like, "Oh, we use AI for blah," right? Okay, right. We're very close to that point where people go, "Well, of course you have AI. Of course
Yeah.
you use AI." That's in some respects, this is almost going to be the shorthand for, we use data. Well, of course you use data. You run a business, you have a website. Of course, I bet you even have a phone number too, right? So that's the point where we're kind of getting, I think, in terms of saturation. What this means is for businesses, you have to be using AI. You have to be harnessing the value of your data, both in your operations and in your analysis. And if you're not, right, that's like saying you're not going to use electricity or running water or have a website, right? You can do it, but you're going to have a very limited potential for your business.
Yeah.
And so that's, I think that's the framework really for the book, looking at how are all these industries going to shift? How does AI become fully integrated into various industries? And then how does that become an assumed invisible part of the operating system of every business? In the same way that, look, you or I, like, if you pressed me hard, I could remember a little bit of DOS prompting code, but most people, especially younger people, they might not even know what DOS is, and they are
Yeah.
so lucky to have never had to program in DOS. But the reality is that is the invisible operating system, right? And that's what AI is going to become part of that. Look, I use a lot of apps. Could I program one? No, right? Did I know enough HTML to make a website at some point? Sure did. Could I do it now? Probably not, and there are invisible offerings that do that.
Yeah.
So this is kind of where AI is. And if I think about, say, finance, something really important to folks who attend the Money Show, I think about spreadsheets, right?
Yeah.
And I remember my father and grandfather were CPAs, and in the 1980s, Lotus 1-2-3 came out. And I think to young people today, it's probably shocking to imagine, especially young people in finance, that there was ever a time where people in finance thought digital spreadsheets would be a bad idea. But there were. There were people who wanted to keep working on paper spreadsheets. And those folks were either very quickly out of a job, out of business, or they came around. And that's AI is like spreadsheets, but for all
Yeah.
industries.
Well, Jason, as you mentioned, you're going to be joining us for the 2026 Money Show. You'll be speaking. The event goes February 23rd to 25th out at the Paris. Your topic is the biggest trends, risks, and opportunities for the year ahead and beyond. And we've talked about some of it there. But since you speak to all kinds of audiences, and in this case, it's going to be investors and traders, what are a few key takeaways that somebody's going to get from coming and hearing you speak? What are some of the things, if you had to synthesize all the stuff we've talked about, the implications for an investor at this point?
Yeah, I don't want to give away all the punchlines, but I think what people will take away is an understanding of what the economy, what's going on right now at the global and domestic macro level, how that's likely to roll forward, where geopolitics fits in for risks and opportunities, how AI and the labor market are interacting right now, and where the most actionable things to do are going forward to make sure that you seize opportunities and manage risks in the year ahead and beyond.
Well, Jason, again, thank you so much for taking some time out to chat with our viewers and listeners here. Viewers, if you're watching this, Jason is going to be speaking at that Money Show event. It's February 23rd to 25th at the Paris. You're going to learn a lot. You're going to have a great time doing it. Jason's our first time speaker there, so we're really excited to have him. Thank you again so much for your time.